Kelvin, as I mentioned, their markets, equities markets at least, really struggling for conviction. I know that you prefer the bond space right now, and we have seen the yield on the 10-year, for example, reaching levels that we've not seen for a decade or so. How much higher do you see yields moving from here?
Well, I think it really depends on what Fed Chair Powell's speech on Friday will likely be. I think he is likely to actually start pushing back on the market's consensus call of a first rate cut in March next year. And I think if that's the case, then obviously, where the bond yields are concerned, they're likely to actually stabilize at this level or perhaps even turn it a little bit higher. But we do think that we've actually seen the last rate hike where this cycle is concerned. So we're actually quite confident that, barring any unforeseen circumstances or any change in inflation data over the next 6 months, that the yields will likely stabilize at this level and perhaps even actually move back to the 4% level.
So if you think we've seen the last rate hike, what sort of rhetoric do you expect to hear coming out of Jackson Hole? Because Chair Jay Powell has wrong-footed markets before with his speech to that forum. And beyond that, what do you expect to see in the next set of dots?
Well, I think what has basically set a little bit of a panic on the markets because in the recent weeks, macroeconomic data in the U.S. has actually been trending upwards and actually been seen as more upward-looking, as more bullish than before. And, it really depends on the consumption figures that's likely to come out in the next couple of months and the inflation data. The Fed itself has basically said that they're likely to be very data-dependent, and that will in turn be an indicator of where the hikes or the cycle will likely be. But from our perspective, we do think that a lot of the data will probably peter out over the next couple of months, largely because of the fact that, where excess savings are concerned, the U.S. consumer is now starting to actually draw down its excess savings, and that by the end of this year will likely actually flatten out. And in fact, on a monthly basis, there's already the savings actually coming through. So the spending can't go on forever in that sense. And at some point, the 5% to 5.25% rates are likely to actually start impacting the global, the U.S. economy on a more gradual basis.
Kelvin, is that why you're seeing more potential upside for emerging market equities than U.S. equities, as you say in your note? And would that include China? I mean, we've just been discussing how many issues that economy faces.
Yeah, I think those are separate issues, but also, at the same time, you cannot just delink both issues. But I think more importantly, the dollar has to actually weaken. We've seen the dollar become increasingly resilient in the last 2 months. And, the dollar at these levels basically means that it's going to be very hard for the emerging markets to actually perform. So that's one condition that must be in place. The second condition is that the Chinese property market must recover or at least show some signs of stabilization. And that, in turn, is unlikely to come in unless you get more widespread stimulus coming through from the Chinese government. What they've done thus far is very reactive, very piecemeal, and that's not likely to move a needle where the property market is concerned. So, property market really needs to stabilize and recover before the emerging markets as a space can actually outperform.